Most people think the stock market is this massive, complicated machine. It's not. It just gets explained badly. Once you understand what a company actually is, the rest of the stock market makes sense. So forget names and stock prices for a second. Think of a company as a basket. And this basket is filled with stuff. Some of that stuff you can touch. Trucks, computers, buildings, physical things. Some of it you can't touch. A brand name, a reputation. Let's take Apple as an example. Yeah, they've got warehouses full of iPhones, but the real magic? It's a brand name so powerful that people will pay twice as much for their phone compared to anyone else's. That's what a company is, a basket full of valuable stuff. Some you can see, some you can't. Now here's the question. Who owns this basket? And how do we decide who gets what? Imagine you're a carpenter. You've saved up $10,000. That's great, but here's the problem. It's not enough to start your business. You need a truck. You need tools. So you go to your friend Jake and borrow $10,000 from him at 5% interest. Now you've got $20,000 total. You buy the truck, you buy the tools, you get to work. Fast forward 1 year. You made $50,000 in profit. Plus, you still got the truck and the tools. So now the question is, how do you split this with Jake? Here's how it works. Jake lent you money. He didn't invest. You owe him his $10,000 back plus 5% interest. That's it. After you pay him, everything else is yours. In financial terms, Jake is what we call a bond holder. You're a stock holder. So here's the difference. A bond is a loan. Give me money, I'll pay you back with interest. Fixed return, lower risk. A stock is ownership. Give me money, you own part of my company. Unlimited potential, but higher risk. Now, Jake might be sitting here thinking, wait a minute, you made way more money than me. And yeah, he's right. But here's the other side. What if your business had failed? What if you made zero profit? You'd have to sell everything just to pay Jake back. He'd get his money, you'd get nothing. Zero. That's the deal. Bondholders get paid first, but only what was promised. Stockholders get paid last, but keep everything that's left. This rule never changes. All right, 2 years go by. Your carpentry business is booming. You want to expand into new cities. You need a lot of cash. You could borrow it, but that's a lot of debt. So instead, you decide to sell pieces of your company. Your friend Maria buys in, then Tom, then a bunch of other people. That money goes straight into the business, and now you can grow. This is called an IPO, initial public offering. It's the first time a company sells pieces of itself to the public, and the money goes to the company. After that, if someone wants to leave, they sell their piece to someone else. So a year later, Maria wants out. She sells her shares to someone else. That person pays Maria. Not you, not the company, just Maria. It's like a used car. Toyota gets paid once when the first owner buys it new. After that, cars just get passed around between people. Toyota doesn't see that money. Stocks work the same way. After the IPO, shares just get traded between investors. And that's what we call the stock market. You've probably heard of Wall Street, the New York Stock Exchange. It used to be guys in suits yelling on a trading floor. Today, it's apps on your phone. Robinhood, eToro, Fidelity. You tap a button, someone across the country taps theirs, and now you own a piece of Google. Every year, trillions of dollars change hands this way. Not going to companies, just people swapping ownership back and forth. So, hold on. If your money doesn't go to the company, why own the stock at all? 2 reasons. First, the stock might go up in value. You buy at $50, sell at $100, you just doubled your money. Second, dividends. Some companies take their extra cash and share it with the owners. You own 100 shares, they pay $2 per share, you get $200 deposited into your account, just for owning it. Companies like Coca-Cola do this regularly. Others, like Amazon, don't. They reinvest everything into growth. Either way, you profit from ownership, price gains, cash payments, or both. Now, the question is, why do some companies pay dividends and others don't? It comes down to what they think is the best use of their cash. A company like Coca-Cola is already everywhere, not growing fast. So they take their profits and share them with the owners. A company like Amazon thinks differently. We could pay you $2 per share, or we could use that money to build 10 new warehouses and become twice as big. They reinvest everything. Neither is wrong, just different strategies. But no matter which type of investor you are, there's one thing everyone watches: the price. So why do stock prices go up and down? Supply and demand. That's it. Lots of buyers, not many sellers. Price goes up. Lots of sellers, not many buyers. Price goes down. A stock is worth whatever people are willing to pay for it. But why do people want to buy or sell in the first place? They're betting on the future. Apple announces some revolutionary new product. People think profits are going to go way up. They buy. Price goes up. A company reports terrible earnings. People think it's in trouble. They sell. Price drops. Tesla tweets about building a new factory. Stock jumps 10%. Sometimes it's logical. Sometimes it's pure emotion. Sometimes millions of people just panic or get excited all at the same time. News, rumors, the economy, everything affects how people feel about the future. And how people feel about the future moves prices today. Okay, so now you understand how all this works, but what should you actually do with this information? Here's the simplest approach, and this is backed by decades of real data. Don't pick individual stocks. Don't try to time the market. Look, most professionals can't beat the market consistently. You probably won't either. I'm not being harsh. I'm just telling you the statistics. Instead, buy a little bit of everything. There's something called an index fund. It's basically a basket that holds hundreds of companies at once. One purchase and you own tiny slices of Apple, Amazon, Google, Walmart, and hundreds more. The most famous one tracks the S&P 500. That's the 500 biggest companies in America. You buy that, you basically own a piece of the entire US economy. Now, I gotta be honest, it's boring. Nobody's gonna brag about this at parties. But here's what matters. Over the last century, the S&P 500 has averaged around 10% per year. Some years it's down, some years it's way up. But over decades, consistently up. Put money in regularly. Don't panic when it drops. Just wait. That's how ordinary people build wealth. Quick recap of everything we've talked about. A company is a basket of valuable stuff. Some tangible, some intangible. Stocks and bonds decide who owns that stuff. Bonds get paid first, stocks get what's left. When you buy stock, you're almost never buying from the company, you're buying from another investor. That's the stock market. Prices move on supply and demand, people betting on the future. You profit two ways. Price goes up or dividends come in. And if you're just starting out, index fund and patience. Thanks for watching. If you want simple explanations of money, finance, and economics, the playlist on your screen is a good place to start.